There, and then you've got T. Rowe Price ringing the opening bell at the NASDAQ. All right, trading has officially commenced. Let's take a quick check of the markets as we're taking a look at the U.S. major averages. The Dow, the S&P 500, and the NASDAQ all opening higher here to begin today's trading activity. Fractional gains, the S&P 500 and the NASDAQ both up by about 0.4%. The Dow higher by about 0.1% right now.
Yeah, and Brad, when you take a look at the bond market, of course, much of that action has really been the focus here as we did see a move higher in the 10-year yields. You are looking at a push slightly to the upside once again today. We're hovering right around 3.7 for the 10-year yield. And flipping over to some of that sector action, we want to take a look at tech specifically because that has really been in focus ever since NVIDIA's results. Well, really much longer than that, but specifically in focus here over the last couple of weeks following that NVIDIA's results that we did get. Technology had led the rebound yesterday following last week's underperformance. Once again today, we are seeing this move to the upside here this morning. Let's take a look here more specifically on tech and what it means for the broader market, because we do have tech leading the way this morning, but the sector that's been the outperformer so far this year has actually come under pressure in recent weeks. The downward move led by NVIDIA. The stock has fallen more than 10% in just the last 5 days, weighing on major averages as the company struggles to live up to lofty expectations. But looking ahead, sentiment, it may be shifting just a bit, and NVIDIA may not have the same outsized influence on the broader market. Joining us now, we want to bring in Scott Cronard. He's Citigroup's head of U.S. equity strategy. Scott, it's great to have you here. And I loved your note that you put out earlier this week. And we wanted to talk to you about it because there has been so much focus on NVIDIA's outsized influence on the market and the fact that NVIDIA has really been driving the gains. Walk us through your current thesis and why you see the sentiment starting to shift just a bit.
Hey, Shauna, thanks for being here on. Okay, so regarding NVIDIA, what our focus here is not that they're not in a really good position to grow. Consensus expectations for 2025 are for 40% earnings growth. We don't doubt that. But what we're looking at is the pattern over the past 15 months, going back to May of 23, when they first gave us a significant upside surprise and guidance raise. What's happened since then is that they've continued to raise guidance with each quarter, but that stair-step function is decelerating. So what we're looking at here is a lessening rate of incremental increase on the heels of the performance that the stock has had over the past year and even year to date. We suspect that what this tells us is that it's still a really important stock for index direction. At 6% plus of the index, it's going to be. But in terms of the more significant upside that it's contributed to the S&P, we think that certainly lessens from here.
Okay, and so if it does lessen from here, then where some of the other, especially as a lot of investors are trying to chart out where the dip buying opportunities are, where would they be apt to perhaps look at some of the repositioning and look at those buying opportunities if there was more of that dip that certainly does occur as we're in September, where everybody's thinking about the September effect?
Right. Well, I think from point of reference would be what happened from the middle part of July to the early part of August, where you saw tech and this Mag 7 cohort come under pressure. When we got down towards those 5,200 levels, Brad, what we suggested at that point was that the setup was that you could begin to play, quote, growth as defensive around concerns of economic weakening. So you give us, sort of another version of what we just been through. We think that's a pretty good playbook for how we're seeing it set up right now. That kind of plays to our broader S&P call, that we're not aggressive at 5,600. That's our year-end target. But as you get down to 5,200, your risk reward begins to get much more attractive going into the year end.
And Scott, taking a look at some of those broader macroeconomic forces here, I guess, what do you see being the key drivers to the market here in the second half of the year?
Well, I think what everyone is focused on right now is the labor situation. And we know we've seen some deterioration. The concern is that as that perpetuates, it begins to feed on itself to the downside. Okay. So we're watching the labor situation, and that's probably a primary focus for the Fed at this point. But, what we're looking at from a macro perspective is a pretty interesting balance. You're seeing many economic indicators show signs of bottoming around historic levels. At the same time, you're seeing some deterioration in other components. So from our perspective, it's a fairly mixed macro bag. But I'd say that would put your downside attention would mostly be on labor and the ramifications that might have for underlying S&P 500 corporate fundamentals.
So with that in mind, I mean, as we're thinking about fundamentals, what type of earnings growth then in the back half of this year are you anticipating?
Well, so we've been of this view that you're going to get a broadening in terms of earnings contribution. So back to the starting point of the discussion, we're still looking at this Mag 7 cohort positioned to post 20% plus earnings growth in 2025. That's pretty hefty, and that's a really strong starting point for assessing broader index. The rest of the S&P 500, that other 493, is fascinating. It posted 5% earnings growth during the Q2 reporting period. That's the first quarter in 6 you've actually gotten a positive earnings growth rate out of that cohort. So this broadening effect is happening. It's just a question of how quickly and to what extent it can extend into 25, the market's willing to price in. What we're arguing is that all told, the setup continues to be for earnings resilience, and we're going to define that by sort of a high single-digit rate of earnings growth in this year, with follow-through for another high single-digit rate of earnings growth for 2025.
So, Scott, when we talk about how earnings are shaping up for the back half of this year and into 2025, some of the recent numbers from FactSet caught our attention here at Yahoo Finance because they have been, at least the expectations here for the current quarter, slashed by 2.8%. That has caused some worry on Wall Street. Just given what you were just saying, is that something that maybe investors should overlook and isn't as big of a headwind as maybe some are seeing it or viewing it right now?
That's a really good point. So we're of the view that, well, with Q2, we got what we considered a beat and hold. So you had a Q2 beat to numbers. Back half of the year expectations did come in a couple of percent, as you point to, Shauna. We think that probably replicates into the third quarter and then the fourth quarter. But keep in mind, the further we get towards the end of the year, the more investors are going to start fast forwarding to the 25 outlooks. And there, even though you get a, let's call it a more measured response to Q3 results, let's say, the setup should still be for an improving dynamic going into 2025. Now, that's taking into account some signs of current economic weakening or softening, but it also begins to set us up for the expected benefits of a lower Fed funds trajectory as we go into 2025. So yes, we're focused on Q3 earnings, where I think consensus right now is for a flattish quarter. We expect a more normal positive beat on that, but the focus is going to be on where 25 numbers are taking us. And again, what I want to emphasize here is even though we're sort of to a certain degree downplaying the influence of that Mag 7 mega cap growth cohort, it's still set up for very solid earnings growth as we go through 2025, almost irregardless of what's happening with the broader market action.
Scott Cronert, who's the Citigroup head of U.S. equity strategy. Scott, thanks so much for kicking off today's trading session with us.
Have a good day.
You too. Coming up, everyone, Apple launching a series of new products, including the iPhone 16. But did Apple deliver on the AI hype everyone was expecting? We discuss with an analyst after the break. Welcome back to Morning Brief, brought to you by Invesco. A crackdown on big tech. The European Union ruling against Apple and Google in two landmark legal cases this morning. For Apple, the court sided with an EU order from 2016, determining that the company had struck illegal deals with the Irish government that allowed it to pay virtually nothing in taxes on its European businesses. Now, for Google, the court agreed that the company gave preferential treatment in search results to its own price comparison shopping service over its rivals. Both companies facing billions of dollars in penalties. Needham senior media and internet analyst Laura Martin joins us now to discuss this further. Laura, it's great to see you here this morning, and thanks for taking the time. Let's start with Apple specifically here. I mean, this Cork, Ireland business has really come into focus over a couple years now. We remember back to the repatriation that the Trump administration was looking to put forward and how that business came into focus. So what ultimately does this net out for perhaps the type of fines that are going to impact the financials for Apple here from your purview?
Well, I think the check just got served. These are socialist governments where the largest U.S. bank companies that have trillions of dollars of market cap didn't pay any taxes. And these companies want their share to pay for their economies. So they're going to basically fine these companies the amount they should have paid tax based on their European revenue. I mean, I think that's the hidden agenda of the EU, is to get some money for the EU from all the revenue that came back to these US companies over the last decade since they started operating.
So do you think that this is part of a broader referendum on US-based companies operating in the EU that we're seeing come forward here and a broader trend?
I do. I think that it was a fool's errand that these large tech companies didn't pay some tax, figure out a way to pay some tax rather than trying to pay no tax, because now the EU has nothing to lose. If these large companies have been paying billions of dollars of tax every year, maybe not the full tax rate, which in socialist government is much higher than ours in the US, but some tax rate, they would have something to lose by taking these companies to court. But these companies now are going to just fine these large companies in order to pay for their social programs.
Laura, let's talk about the other big news coming out of Cupertino yesterday, and that was a new lineup of iPhones, the iPhone 16. We also got a new watch, new AirPods. Let's focus specifically first on what's on the screen right now, the new iPhone 16. Judging by the title of your note and reading your quick reaction, it doesn't seem like you're too impressed. Why is that?
You know, not ready for prime time. Look, in fairness, Gen AI is 15 months old. And the best apps on the Apple iPhone are made by third parties, not by Apple. So they aren't there yet. So this is just too early. They're not even going to have Apple Intelligence on the phone at launch. I just think there's no compelling reason that somebody should run out and buy a new iPhone 16. You should wait for the 17 because it's going to have either cooler stuff and there'll be more Gen AI capability. The one thing Apple did that was smart is they increased their subsidies for trade-ins by like 20 or 30%. So it's like a couple $100 if you want to trade in an old iPhone, like iPhone 11 and more recent, into a new iPhone. So it's like free, but I would wait if it was me. There's just nothing compelling about it. It's got new colors and it's thinner and it's made of titanium and the camera's better, as it is every year. I would say wait a year until we get some real Gen AI innovation on the next iPhone. But the one being delivered on in 10 days, not that interesting.
You know, I'm just looking at a roundup from both yourself as well as some of the other colleagues in the industry talking about this September event. KeyBank saying the September event was a modest negative, lack of positive surprises. Similar from Morgan Stanley, no major surprises. Bernstein saying it was more evolutionary than revolutionary. And we just heard your commentary there. But this all comes back to this super cycle and how much that plays into the guidance for Apple. From your estimation, what percentage of that install base would need to really go out, get this new product for that super cycle to come to fruition here?
So, I mean, I think over the next 4 years, I would expect every single person in the iPhone ecosystem to replace their iPhone because they're aging out. So the question is when that starts happening, because then we get over delivery of earnings per share. So I just don't think it's going to happen this year. So we're going to have another year of anemic growth, single digit growth, and the stock is expensive. So I think I think estimates will come down as a result of this, and I don't see a lot of people upgrading. I think they'll wait a year, and then the entire iPhone ecosystem will replace itself, and that, like, let me call it a library replacement cycle, which is what we call it in the film business when you have a new technology. That's interesting because that library, that iPhone replacement cycle will drive 2 years of over-delivered earnings, and that will be interesting. But I don't think it will start this month and this September. It will start maybe next month and next year.
Laura, when it comes to the announcements that we did get from the watch and from the AirPods, talk to us about whether or not, and I believe it's yes, just judging from your note here, but whether or not you see that locking more consumers into Apple's ecosystem and how big of a driver that's ultimately going to be here in the near term.
Right. I thought that the watch and the AirPods pivoted strongly towards health, which I think is really interesting because strategically it's trying to make the iOS ecosystem a must-have, not a nice-to-have, especially for older demographics. So they're doing more and more things that use all of the data that you have on that handheld computer called an iPhone, and they're using it to track sleep apnea, which is apparently undiagnosed in 80% of the world's population, according to Apple. And similarly, hearing loss, which is undiagnosed in 75% of the world's population. So to the extent you become more dependent on that device for your health issues, and all of that data is privacy locked in your device, that is a really interesting competitive advantage and competitive positioning for the iOS ecosystem and their ancillary products. So if you convince somebody to buy a new Apple Watch because they're worried they have sleep apnea and you wear it to sleep, that gets them to then backwardly integrate into the iPhone or stay in the iPhone ecosystem longer. So these ancillary products do create ecosystem lock-in for Apple, even if they're doing sort of a bad job on their iPhone specifically.
Laura, I want to switch gears here just a bit and talk about one of the big headlines that has been affecting your coverage list when it comes to the DirecTV Disney blackout. We talked about that a lot with Monday Night Football last night. Now we had the presidential debate tonight, and some viewers could be impacted. I'm curious just from the backlash, what you think that looks like. Obviously, this isn't the first time we've seen this type of standoff happening within the industry, but what does that ultimately do you think, just in terms of, I guess, pushing more people to then likely opt no longer for cable and go for some of those streaming options?
Yeah, so everybody loses. So content and distribution are complementary networks. They both win together and they both lose together. This is inevitable because Disney keeps wanting to raise price, and they get, because of ESPN, like $12 a month, by far the highest price, and they get paid for every customer, whether or not that household watches sports. DirecTV wants to pay less. It doesn't want to pay as much because it has negative margins in the cable business, basically. So these kinds of disputes are going to become more and more common, in my opinion. So I'm not at all surprised by that. My guess is it will be resolved because NFL season is too important for DirecTV, and they don't have Sunday Ticket anymore. So I think it will get resolved, and it will get resolved, in Disney's favor probably this round. And if I was DirecTV, I'd just do a shorter deal, 2 or 3 years, but get ESPN back on the air for the NFL season.
Laura Martin Needham, Senior Media and Internet Analyst. Laura, always great to grab some of your insights. Thanks so much for speaking with us this morning. All right, everyone, we've got more Morning Brief straight ahead, sponsored by Invesco. Welcome back to Morning Brief, brought to you by Invesco. Now time for some of today's trending tickers. First up, we're watching shares of Oracle, ticker symbol ORCL. The company reported quarterly profit and bookings that topped estimates. The results signaling that artificial intelligence demand continues to boost its cloud computing business here. Shares ripping to the upside right now by about 13% at the start of trade. I'm just going to take to one of the more wild things that we heard on this earnings call because it really did get interesting. And I kind of nerded out about this and had to look up some stuff afterwards. But it's nuclear reactors to power future data centers here. Larry Ellison talking about this on the call, building giant data centers because of all of this AI demand that they're seeing with ultra high apartments, RDMA networks. I'm still looking into that one a little bit more. And then 32,000 node NVIDIA GPU clusters. So a win for Oracle, a win for NVIDIA potentially on this too. And this is something that Oracle has already proven that they're talking about they're very good at here. And so that's why they're doing so well, they say, in the AI training business. They talked about this on the call, and they're looking at designing a data center north of the gigawatt. And they found a location, it sounds like.
Yeah. We know that they have been allocating more and more investment towards building out data centers. I believe it was about $10 billion in terms of future plans that we have gotten the latest figures here from the company. But I think my big takeaway here from this quarter is just how much growth they are seeing within that side of their business, and ultimately what that signals here going forward, because it was another strong quarter despite some of the seasonal weakness that we have been seeing throughout the industry. Morgan Stanley coming out saying that they are encouraged by the bookings growth once again picking back up here this quarter. I also do want to point out, though, that it wasn't all roses here for the company. Some analysts did take some issue here with parts of the report. JP Morgan was one of those, saying that most of the revenue outperformance is derived from license revenue. And the reason why they took a bit of an issue with that is they're saying that they, quote, prefer to see more of the outperformance driven by recurring revenue stream, which makes a lot of sense when you think about future growth going forward. So again, there is a lot to like within this earnings report, a lot to be encouraged about. But again, there is some sort of hesitation here from some analysts. At least it's not all butterflies and rainbows, maybe is the best way.
A lot required to build out these artificial neural networks in the world that they were talking about.
Certainly. All right, we also spoke to AWS CEO Matt Garman about the partnership here with Oracle. And here's what he told our very own Madison Mills.
They thought about how integrating backups into S3 could work. We thought about how integrating AI services into Oracle databases would work. We thought about how zero ETL could work so that customers can seamlessly use their Oracle database running inside an AWS environment with low latency, but actually use that data to do analytics inside of Redshift or other services. And the Oracle team was open to that.
So clearly you could look at this as a positive here for Oracle teaming up with AWS. We know some of their past partnerships when it comes to what they have with Microsoft, when it comes to what they have with Google, their multi-cloud agreements within that space have proven to be a very fruitful and very beneficial here for Oracle. So you could then make that argument that this would then even further strengthen that side of the business.
Yeah, absolutely. NVIDIA as well, one of those that we mentioned. Sure. Huge partnership there.
All right, keeping our eye on shares of TSMC as the chip giant reported revenue that rose 33% last month, and a positive sign to investors betting on a smartphone market recovery and sustained demand for NVIDIA's AI chips. Despite that, though, we are looking at losses of just about 1.7%, and that could be, or a reason for that could be that despite that we did see an uptick of about a third here in revenue last month, it was actually slower than the growth we saw the previous month. That growth rate of 45%. So again, a bit of a slowdown there might be something that the street is taking a bit of an issue with. But again, we're not looking at a huge move lower here, just about 1.5%.
Yeah, it seems like the analyst reaction right now, from Bernstein at least, if September follows the average seasonality of the past 8 years, that the third quarter 2024 revenue would come to about 5 to 6% above both the guidance and the midpoint consensus here. So that's something worth tracking on a go-forward basis from TSMC. But this continues to come back to how much leeway, how much of a line some of the investors are going to give TSMC on their AI infrastructure spending going forward from here too.
All right, we'll keep right here on Yahoo Finance. We are just getting started. We've got much more of your market action ahead. Again, when you take a look at the major averages, you've actually got the Dow now in negative territory, giving back some of its earlier gains. S&P and NASDAQ, though, still moving to the upside. Some outperformance here driven in by tech, and you can see that by the outperformance of the NASDAQ so far this morning. Much more coming up next on Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. We're just about 30 minutes into the trading day, and we're watching three catalysts impacting markets: the EU's crackdown on big tech, Fed proposing new banking regulations, and the first presidential debate.
All right, EU regulations logging big wins against Apple and Google. The big tech firms each losing court battles and will be forced to pay billions in penalties. Shares of both companies, they're pretty much flat today.
And Fed Vice Chair of Supervision Michael Barr is unveiling a new proposal for regulations at America's biggest banks, dropping the requirements for bank assets. We'll give you the latest in just a few moments.
Plus, Vice President Kamala Harris and former President Donald Trump face off for the first time tonight. With the two candidates neck and neck in some recent polling, investors are looking for a clearer picture on each candidate's economic policies. Well, Fed Vice Chair for Supervision Michael Barr is speaking right now, previewing a proposed package of revised rules for the country's biggest banks. Here with the latest, we've got our very own Jennifer Schonberger. Jennifer, great to see you. What do we know so far? What are we hearing?
Good morning, Brad. Great to see you as well. The Federal Reserve unveiling its planning sweeping changes to massively scale back a proposal to raise capital requirements for the nation's largest banks after politicians and banks had pushed back on an initial plan, warning that it could restrict lending and hurt the economy. The new proposal, known as Basel III, would increase capital levels for big banks like JP Morgan and Bank of America by 9%. That's down from half of the original plan from more than a year ago that set the capital increase at 20%. Now, banks with assets of between 100 and 250 billion, which were initially subject to the stricter standards of the largest banks, would no longer be subject, other than the requirement to recognize unrealized gains and losses of their securities and regulatory capital. This is a major reversal following a string of regional bank failures last year, led by Silicon Valley Bank. Fed Vice Chair of Supervision Michael Barr laying out his vision this morning in a major speech here in Washington at the Brookings Institution, saying, quote, "Capital has costs too. As compared to debt, capital is a more expensive source of funding to the bank. Thus, higher capital requirements can raise the cost of funding to a bank, and the bank can pass higher costs to households, businesses, and clients engaged in a range of financial activities." This is certainly an about face for Barr after even colleagues on the Federal Reserve Board, including Fed Governor Mickey Bowman, had voiced concern about this in addition to the banks. Barr says that today's proposal reflects public comment and that it improves the tiering of the proposal and better reflects risks. Now, these changes were made in concert with the FDIC and the Office of the Comptroller of the Currency. All three of these institutions would need to vote in concert to finalize this new proposed rule. Barr says, however, this is just an interim step at this point, and that the Fed is taking comment on this new proposal. Guys,
all right,
back to you.
Jennifer, thanks so much for laying that all out. And we would be remiss not to say happy birthday, Jennifer. Thanks so much.
Oh, thank you so much.
Appreciate it. We'll talk later. All right, let's turn now to the broader market. Our next guest saying that the dip buyers came in for the sale yesterday, but will the buying continue? Joining us now, we've got here on set, live in living color, Kenny Polcari, Slate Stone Wealth Chief Market Strategist. Great to see you here, Kenny, and thanks for taking the time. So, as we're thinking about some of the dip buying opportunities that some investors are trying to take advantage of right now, what are you kind of lining up and where you would be putting additional chips on the table?
So I think you have to take a broader look at where we think the market's going over the next 6 or 7 weeks, just because we're in that seasonally weak time in the market, August through October. I think that the August lows of 51.16 are likely going to be tested again, which means that, as an investor, as a long-term investor, you just need to be a little bit cautious. But look, key names, NVIDIA, that's down 25% off its June high, is a place that I would actually be I would put money to work there now.
You think it rallies back to the high?
Yeah, well, I don't think it rallies back to the high, but I think it's on sale 25%. As a long-term investor, I'm not a trader, so I'm not looking for it to rally 2 points or 10 points and then sell it. I'm in there to buy it, to hold it, right? But when something goes on sale at 25% down off the recent high, then you have to at least look at it. Now, if you're worried about further downside for the broader market and you think it's going to get get dragged with it, well, then just sit back a little bit and wait. I think, for most of the clients, that's the conversation I'm having just about being patient, right? Because patient in this case could be a virtue.
Kenny, what do you think the outsized influence is going to be for NVIDIA looking forward for the broader market? And I bring that up because we were talking to Citi's Scott Kroner earlier in the show, and he was talking about that shift that we certainly have started to see over the last couple of months. Does that continue?
Yeah, listen, I think it's a little bit overdone, that shift that everyone's worried about. Look, I think we're at the very infancy stages of AI. I think NVIDIA sits at the nexus of this tech revolution that's happening. NVIDIA, for me, is a key name, right? Now, do I think there's going to be fits and starts, and it's a high-growth name, so it's got lots of volatility in it? Absolutely. But over the long term, I think NVIDIA is just a core name and a core portfolio. And I think investors have to depends again on who they are, what their time frame. Are they a trader looking to day trade it? Are they an investor looking for a good entry point to either add to or initiate a position?
We're looking at consumer discretionary this morning, one of the leaders here, and it's jousting with technology right now here, at least during today's trading session. When we think about the consumer, though, right now, there have been flashing warning signs, especially ahead of what is either going to be a soft landing, a hard landing, potential recession. Right. How should investors be thinking about the consumer with relation to some of that discretionary spending and the stocks that will show up in?
So I'm to that point, I'm much more about consumer staples than I am about discretionary, because I think the consumer is stretched. I think the consumer is going to run into problems. I think we're already seeing consumers run into problems. We're seeing people live on credit cards, and discretionary is just that. It's discretionary spending. Those are wants versus needs, right? So I would be cautious on that sector at the moment, and I'd be more focused on the staple sector. While it's boring and not sexy, I think it plays nicely in an environment where you think it's going to be a little bit of a pressure on the broader market and on the consumer.
So, Kenny, then what does that tell us about your view then of the overall U.S. economy and whether or not maybe some of that slowing of the growth that we have seen, that continues?
I think that does continue. And by the way, I'm not necessarily against the slowing of the economy, because I think a lot of it was juiced up because of the injection of monetary policy injection as well as fiscal spending. I think a lot of it. So I think the economy has to slow a little bit. And by the way, I wouldn't even mind if we had a little bit of a mild recession, not a deep one, because a mild recession will reset it, right? You'll see prices actually come down if we have a mild recession. Right now, prices are, while inflation is slowing, prices are still rising. But if you have a recession, then you'll see the prices of things that we care about, food, energy, utility bills will all start to come down a little bit. So I'm not necessarily in the camp that we shouldn't go through that cycle.
So then what does that tell us about the positioning of small caps right now? Because that certainly has been some of the trades that we've been hearing a little bit more about, but continues to lag.
Right, but small caps will typically benefit. If rates go lower, small caps will typically benefit because they end up using and borrowing a lot of money, right?
But even in a slowing economy?
Well, so there's the rub, right? You just have to be a little bit careful in terms of which small caps kind of you're looking at, what space they're in, right? Because they could be small caps in a range of sectors. And so you have to, I think, just be a little bit cautious on which names you're looking at. But overall, I think we're in for a semi-soft landing. Not a hard one, but I don't think it's going to be completely soft. And so therefore, I think you just have to be conscious of your time frame, where you are in the life cycle, where you are in the investment cycle, right? If you're 30 years old, it's a very different conversation than if you're 60 years old, right? In terms of how you want to be weighted and where you want to have your exposure.
So wouldn't that mean then that the economy is actually more resilient than markets are pricing in right now? I'm looking at a note from BlackRock saying U.S. earnings growth are broadening beyond early AI winners.
I think the economy is fairly resilient, right? I don't think we're going over the edge. I think all this panic about we need 50 basis points because we're going over the edge, I think that's baloney. Because I don't think we're going over the edge. And like I said, I think actually a slowdown would be better for the economy long range, because we can't keep going at the pace we were going. Because then if we do, then the correction is going to be even more difficult, right? And so I would actually welcome a little bit of a mild recession.
All right, Kenny Polcari, always great to have you here on set with us. Thanks so much for taking the time to join us this morning. Kenny Polcari of Slatestone Wealth. NVIDIA may no longer be the king of the market. At least some are saying that. The stock has been under a bit of pressure since its earnings release in the S&P 500 has been out of step with the stock since. So is NVIDIA's outsized impact on the market behind us? Here to discuss, our very own Josh Schaefer. And Josh, you wrote about this in this morning's morning brief. We talked to Scott earlier on Yahoo Finance here this morning, but I'm curious just your takeaways from this and maybe what this signals about some of that leadership going forward.
Yeah, to me, it's about what's driving the market right now, right? And what's been driving the market since basically, we'll call it July 1, the start of the third quarter, right? So if you take a look at what we put as our chart of the day to go along with the brief this morning, we're looking at sort of what's been outperforming and underperforming the S&P 500. So we've got quite a few lines here, but orange is your S&P 500. It's a little under flat. And you look at real estate, utilities, financials, all well above the S&P 500. Then below that, you see tech, you see NVIDIA. And so what this is telling us that for a while, these charts were really flipped, right? You had NVIDIA well above the S&P 500, significantly outperforming and sort of pulling the index up. Well, now what's keeping the index from sort of the floor falling out? It's the other sectors that don't necessarily involve tech, that don't necessarily involve AI. We could have a nuanced discussion about how much utilities involves AI, but we'll table that for now. But I think largely when you look at that chart, what you're seeing is a market that is pricing in rate cuts and a market that is pricing in a slowing but still stable economy, a soft landing. And it's macro that's driving the market right now, not NVIDIA's earnings. This was the second straight quarter that we saw NVIDIA have one move and the market have a different move. NVIDIA fell on earnings, the market didn't really fall. Go back last quarter, NVIDIA shot up 20%. The market didn't rise with it. So it seems like right now we are in a macro moment where something like CPI matters more to the index, that comes out tomorrow. The Fed next week matters more to the index than this AI story and this earnings story, which, as we know, wasn't really the case for the first 18 months of this bull market. So it seems like we're in a little bit of a different moment right now.
I mean, regardless of what CPI looks like, is 50 basis points clearly going to be enough, or not even enough? Is that even on the table at this juncture here? Because that's what Kenny was talking about. I think his exact words, 50 basis points is baloney, which means that for the tech sector that relies, or at least has been a beneficiary when there's a cutting cycle, that you could see tech just continue to have some of the favor that's fallen in its direction broaden out to other areas of the market.
Yeah, Brad, I mean, it's going to be interesting. It feels like 50 is on the table depending on who you talk to, right? And maybe we'll see what the inflation print does with that. But it seems like if you were in the 50 basis point camp before the August jobs report last Friday, you're still in it, right? So for those people, it's still alive. And I think it comes down to what the questions are going on right now inside the Fed. And we don't really know the answer to that of how interested they are in sort of getting back in line here. But I think, again, talking about sort of the market action we've been seeing and what that would mean, if we don't get 50 and it doesn't feel like the Fed is going to be aggressively cutting, it will be interesting to see what happens to a sector like real estate that has really been rising because of the hopes that you're going to get 100 basis points of cuts this year. Right. If you don't get 100 basis points of cuts, what happens to some of those sectors, maybe even the financials? It will be interesting to see, maybe even utilities, right? We mentioned there's an AI play there, but that's a sector that benefits from lower rates. And so does this broadening trade really falter if the Fed goes 25 next week and maybe doesn't signal that they're that itching to go 100 over the year to meet the market? That's going to be probably the trend to watch post Wednesday's FOMC meeting on Thursday and Friday and see what the market leadership is there. Because we know when people have gotten worried, they've gone back to tech, right? It's been, oh boy, let me go buy the companies that have done well. Sure. So if you see that rotation, you could argue it's actually a little bit defensive from investors.
Yeah, exactly. And we have seen that be a defensive play like you're talking about. And I think you bring up a great point, right? Is there too much optimism priced in to some of these sectors when you talk about the outperformance recently of real estate, of financials, versus maybe what reality?
We've been pricing in the soft landing, right? Yeah. When you look at that chart, the soft land, that's pricing of the soft landing, right? So if that narrative changes, then you're probably going to see leadership shift.
Certainly. All right, Josh, great stuff. Thanks so much. Let's take a quick check of the markets. Just about 45 minutes into the trading day, this market check sponsored by Tasty Trade. We're seeing a bit of a reversal for the major averages. You now have the S&P 500 back below the flat line, off just about 0.1%. The Dow still in negative territory, off just about 250. The Nasdaq, though, the low major average, holding on to gains well off the highs of the session, now up just about 0.1%. Flipping over to the action that we're seeing play out in yields in the bond market, we are seeing the 10-year yield slightly moved to the upside here, just barely, still hovering right around 3.7, Brad.
Let's also check in on a sector basis here. Tech, let's go there first. We were just talking about it. XLK, as of right now, it's one of the outsized performers here on the day's activity. It's up by about 0.6%. Additionally, let's check in on consumer discretionary. That was leading the pack at one point. It is still jousting for one of the top positions on a performance basis, percentage-wise here. It's up by about 0.4%. And then also communication services. This has been an interesting one. We've seen this one kind of hyper oscillating between gains and losses here, but as of right now, you're seeing it down by about 0.1%, 45 minutes into trade. We've got all your markets action straight ahead. Stay tuned. You're watching Catalysts.
Now time for some of today's trending tickers. Throughout the trading day, you can track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. Scan the QR code below to check out the latest. Well, let's kick it off with Apple. One analyst saying that health, safety, and convenience shining at yesterday's event. Joining us now is the analyst behind that note, Bank of America's Wamsi Mohan, maintaining his buy rating on the stock, price target of $256 a share. Wamsi, it's great to talk to you again. So I'm taking a look at your note here. You're saying that the new devices, the focus here is on driving more users to the ecosystem. Do you think these new devices, is that actually going to do that here for Apple?
Yeah, thanks for having me. Great to see you again. Look, I think that absolutely we're broadening out the ecosystem here with a bunch of new products. And when you look at the breadth of what's being offered, right, for the watch, for instance, sleep apnea is a new feature that would be interesting to some people. I think when you look beyond that into the health and fitness category in general, that's very, very broad, right? Like now they've incorporated diving, and there are things very specific with respect to diving, for instance, that diving enthusiasts can use. But beyond that, like, there are features additions for golf, for, a wide variety of sports. And the Ultra 2 in particular is very compelling for an upgrade for users who haven't had that experience yet. When you look at AirPods, those are very compelling too, right? Like both in terms of the hearing ability to be toned down when your environment is too loud, for instance, but also functioning as a hearing aid for milder or maybe even medium hearing issues for people. So I just think that the number of applications that you're seeing is starting to broaden out, which brings in new users into the ecosystem. And that's not even including the phone, really, right? And the phone obviously has got a whole bunch of new features, including this visual intelligence, which I think will become a real thing very quickly as consumers find it super easy to, with just one press of a button, now starting to get information as opposed to previously having to go into apps and then ask, what does this image really represent, right? So you're just making it so much more convenient for users to use some of this new technology, what you're doing, and on a daily basis.
So it's a convenience factor, but where's the wow factor? I mean, if you're looking across a lot of some of your colleagues who are analysts covering Apple as well, and what the rest of the industry is saying right now, it seems like the mode in the reaction is there's a lack of positive surprises. KeyBank saying that. Morgan Stanley saying no major surprises. So where is that wow factor, and does that extract some of the pricing power that Apple has had in the past?
Yeah, I think that we have to look at the wow factor a little bit differently this cycle. And what's really different this cycle is it's a software-driven cycle, right? In the past, we've never really had cycles that were software-driven per se. What you've had is hardware upgrades, whether it's larger screen size, form factor changes, whether it's OLED, all very hardware-centric upgrades. The difference this cycle is that software features will really make productivity and usage of your phone better over time. So is there a killer app that got announced at yesterday's event? No. But the killer app in my mind is that this is actually a productivity enhancing tool over time. So you invest in this device, and then you're going to get enhanced productivity as the software upgrades kick in. And by the way, the notion of agile is going to be front and center because we're very used and accustomed to major OS updates once a year, right? Like it's iOS 18, but before that, 17, 16. The annual cadence has been very predictable. But what we're going to see now is these intermediate, fairly significant increases in capacity and capability as they integrate both Apple Intelligence, but also other third-party LLMs, like whether it's OpenAI or going to be Google Gemini over time and others. And so the functionality that you can get from the device is actually changing through the course of the cycle, which is super interesting and hasn't really happened in prior cycles. So yes, is there a wow factor from yesterday? Well, I think the technology is quite amazing and will drive upgrades, but to say that, what is going to be the next catalyst, I think it is the software upgrades that will actually kick in over the course of the next 3, 6, 9 months that will make the device so much more useful and user-friendly.
Wamsi, we also got an announcement from Huawei just after Apple's event. They held their own. They had that brand new phone, lots of excitement surrounding that. We know that Apple has faced some challenges within China. I'm curious from a competition perspective, how big of a headwind is that, a larger headwind than maybe what has already been factored in?
Yeah, no, it's a great question. Look, I mean, Huawei obviously in China is a formidable competitor. When U.S. sanctions went into place back in 5 years ago, what you really saw was the China market was shrinking in absolute terms from a smartphone market perspective. And Apple was taking share over there. And the share gains came because there was no other true alternative of a high-end phone. And so we estimate about 15 to 20 million Chinese smartphones switched to Apple over that period of time. And now Huawei is coming back with a product. Obviously, the volumes of this product are still a little unknown, right? It's going to be challenging because there are a lot of constraints on their chip manufacturing facility abilities. And I think what that does ultimately is constrain the total amount of volume and the performance that you can get if you're not at the leading edge of the product. We also heard something interesting from Apple yesterday, which was they mentioned that support for the Chinese language was coming in 2025. So that might be an indication that Apple Intelligence actually does get rolled out in 2025. So the combination of Apple Intelligence rolling out and the fact that you are going to give up some share with respect to Huawei that you took over the last 5 years. The combination of those two is relatively net neutral. We think that Apple will continue to take share in China in the long run. Obviously, you're giving up some cyclical share that you took over the last few years in the very near term. Longer term, we're actually very optimistic about the China potential because the middle class is actually increasing a fairly significant amount in emerging markets and in China. And all of that is going to add incremental users into the Apple ecosystem.
All right, we'll see if they have to launch a trifold phone to be able to compete as well, even furthermore. Wamsi, thanks so much for taking the time here with us. Wamsi Mohan, who is the Bank of America Senior IT Hardware Analyst. Appreciate the time.
Thank you for having me.
Certainly. And a few other tickers that we're following this morning. Southwest Airlines board getting a major overhaul. 6 members will retire in November, and the executive chairman, Gary Kelly, will step down in 2025. The shakeup comes amid pressure from activist investor Elliott Management. Shares right now are down by about 4.5%. This was a significant effort from Elliott to really try and reshape the board towards some of its own inclinations, and ultimately there was a letter that was put out to address some of the corporate governance changes, and that was sent to the employees internally, really just speaking about, and shareholders, I should say, is who that went to, really talking about how Elliott Investment was met with. The objective was to meet and then ultimately commence productive dialogue. That dialogue led to some of the overhaul that we're talking about here today, and it's a larger question of what the future of Southwest Airlines looks like as a service, especially if Elliott's position is we need to extract even more profits from this business. Does that mean consumers are paying more for those tickets or getting nickel and dimed at certain corners and turns through their flight experience?
Yeah, and I think Elliott would also like to see a bit more changes coming to leadership as well, because we know that they have been pushing for the ousting of CEO Bob Jordan. That, in fact, has not happened. Southwest reaffirming its support for CEO Bob Jordan. But again, remember that Elliott pushed for even more than this. They proposed 10 new directors for the 15-member board, and they have accused Southwest of refusing to modernize their operations. Therefore, that hurts shareholders, leaving Southwest really unable to withstand some of the operational and competitive challenges that we are seeing from others within the industry. So Elliott's still pushing for even more changes than what we are seeing from Southwest. Southwest coming out saying that they are trying to work with Elliott here to find a solution here going forward. They want it to be a quote-unquote collaborative resolution with Elliott here, and they have proposed, again, the 10 new directors for the 15-member board. So again, continuing to be a stock to watch here. At least today, we're seeing a move downward in the stock. We know it has been an underperformer, especially when you compare it to the broader S&P. Well, shares of Hewlett-Packard Enterprise, HPE, taking a hit after the cloud services provider began a $1.3 billion stock sale to fund its purchase of Juniper Networks. You can see that stock off just about 7.5%. Now, this is really to no surprise. They're funding this deal that they had announced here for Juniper, obviously setting sights on that company here in order to expand its business, the push further here for this company going forward. But again, I think the questions going forward is exactly surrounding the momentum maybe behind HPE's business. They had put out pretty solid results here most recently last week, raising their annual profit forecast, citing increased demand for AI servers, a lot of that driven by higher enterprise spending on AI infrastructure. So again, raising some money here for this deal, a $14 billion in all-cash deal, and its attempts here to try to enhance some of their AI offerings.
Yeah, a sense of urgency, especially on the HPE side, and especially considering the valuation right now for Juniper Networks. Market cap sitting just shy of about $13 billion here. So some urgency to get this deal done so that they don't face too much higher of a premium that they would need to make sure that they're able to offer to Juniper Networks for the purchase here. The stock, it's up by about 30% year to date. So at this juncture, HPE just trying to get the deal done in any kind of financial capacity and way possible here. So we'll see exactly how this comes to full fruition for the company, both of them at that. All your markets action straight ahead. Stay tuned. You're watching Catalysts. Fed Vice Chair for Supervision Michael Barr today outlined regulators' revised proposals for Wall Street banks after industry pushback.
It is critical that banks have the capacity to continue lending to households and businesses through times of stress. Bank capital is a key component of this resilience, and bank capital rules help to ensure that banks are holding capital commensurate with the risks of their activities and the risks that they pose to the U.S. financial system.
So under the new rules, capital requirements for the nation's biggest banks would increase 9%. That's less than half of what was originally proposed. Still, many on Wall Street are dissatisfied with the revised proposal, including our next guest. With us now to discuss, let's bring in Chris Whalen, who is the Whalen Global Advisors Chairman. Chris, thanks so much for taking the time here. So you think it shouldn't have gone this far. Why is that?
The whole focus of Basel is on capital, which is what it's been focused on for 30 years. I think they should have focused more on things like market risk. Silicon Valley Bank, for example, is a case in point. And so, the Fed was caught flat-footed when the industry pushed back. And then since that time, we've had the Supreme Court decision in Roper, which essentially eviscerated any notion of deference to federal regulators. So if the rule is not supported explicitly in the statute passed by Congress, then the federal regulator is vulnerable to losing in court if the industry chooses to sue them. You have a case right now where the industry is probably going to sue the Fed and the other regulators on a rule regarding broker deposits. You may also see the mortgage industry sue the Consumer Financial Protection Bureau over a revision to the regulations for mortgage servicing. So, the Supreme Court decision has changed the landscape, and the Fed knows it. The Basel process in particular is very vulnerable because it's not really enshrined in U.S. law. It's an understanding among finance ministers that goes back almost 4 decades. More than that, really. And it doesn't have any basis in statute. So if JP Morgan decides to sue them over Basel, they'll probably win.
No, it's interesting there, Chris. A lot to get into. I guess my first question is, even though this is watered down, I know you don't agree with it. You're saying it doesn't address some of the risks or it doesn't address the issues that need to be addressed. But what we have here, how big of a challenge is this going to be, given the fact that we did see this watered down version versus what had already been priced in?
Well, the capital piece that you just referred to in that piece from Barr is a big part of it. The large banks were not happy seeing a 25% increase in capital because they don't need it. These banks are giving back capital to investors every quarter. In fact, they would like to give back more. The banks are under-levered in terms of opportunities. And most of the new business expansion, where has it gone? Non-bank finance. You guys have been watching that process along with me for the past 5 years. So I think that the regulators are still not looking forward to future risk. They're looking behind. And there's so much detail that has not been addressed yet by Vice Chairman Barr and his comments that I think the industry would like to see the Fed junk this entire proposal and repropose it. The Republicans in the House have already said that. And I think if you see Trump win, this whole Basel rule process is going to go by the wayside, and we're probably going to start again. I have said for a long time the U.S. should withdraw from Basel. There are so many points of friction between Europeans and the U.S., particularly in areas like housing finance, that I just don't understand why we're trying to make our banks fit into their world, which is very different.
Chris, what do you think
is about government finance?
What do you think it would look like then, more specifically, under Trump? Is he any of that?
I think you would probably leave capital rules where they are.
Yeah.
I think that you would see less effort, led mostly by the Yellen Treasury, to limit banks lending to non-bank financial companies. There's a big proposal buried inside Basel that has not gotten much media attention, but it would severely hurt the residential mortgage sector. So there's a lot of pieces to this that don't make sense. And just reproposing it, I think might not be adequate. I still think you might see the industry fight, believe it or not.
I mean, Yellen probably is not going to be there most likely as well. So
No.
this would be under a different Treasury Secretary most likely. There's much more to this
Yes.
conversation. Chris, we got to leave things there on the day. Chris Whalen, who's the Whalen
Have a great
Global
day.
Advisors. You too, Advisors Chairman. Appreciate it. We've got all your markets action ahead. Stay tuned. You're watching Catalysts.
Two years after the CHIPS Act passed, the Biden administration has invested roughly $34 billion in building out the U.S. semiconductor manufacturing sites. But China is moving quickly to ramp up their own capacity, importing more semiconductor equipment than any other country this year. To discuss where things stand, we want to bring in the architect of the CHIPS Act, Ronnie Chatterjee. It's great to have you back on the program here with us, a former White House CHIPS coordinator and a professor of business and public policy at Duke University. Ronnie, it's great to see you. So I guess as we lead up to the debate tonight, looking ahead to November elections, I'm curious just to get your assessment on where things stand, given the money that's been deployed and given the future growth that we are expected to see from some of those larger names like Intel.
Well, it's great to be here. I think 2 years on, you have $30 billion over roughly 15 projects across many different states. So the government's done a great job in terms of making the announcements, these preliminary memorandums of terms they've reached with all these different companies. And they've done a good job of getting the major players in there. That was a big question early on. But you're seeing that now with Intel, with Samsung, with Micron, with SK Hynix and TSMC. We're the only geography in the world that has the top 5 advanced logic and memory producers all in the same place. So that stuff's gone really, really well. I think what you got to watch going forward is the cyclicality of the chip industry, something you talked about in this show before, how that affects the government strategy going forward. I doubt it'll come up on the debate. It's a little wonky, but it's going to be really important to watch over the next 4 years.
Yeah, we're going to be talking about that for sure in a hot second here. But when you think about the future cycles of chip purchases as well, I mean, you have companies like NVIDIA talking about million chip data centers. You had Oracle in their earnings yesterday talking about needing nuclear reactors to power data centers in the future as well, and they're already breaking ground and ready to design one. So what does that signal to you about just the type of purchases, at least a new baseline that we should expect for chips purchases from this point forward?
Well, I think the AI infra that which you're talking about is huge. And you're seeing companies from the hyperscalers on down making massive investments in AI infrastructure. And that includes data centers and GPUs, and as you know, the energy to power them. And we're still figuring out some of these deep technology problems in terms of how we're going to power the data centers we're going to need in the future. I see that as really positive for the chips industry. I mean, honestly, we needed the CHIPS Act before the AI boom. And now with the AI boom, we're going to have a chance to participate in manufacturing some of those high-end chips here in the United States. So I see it as both a great tailwind for the industry, but also a really important sort of goal for the U.S. government to make sure that the U.S. plays a role in manufacturing those chips. And that's what I see happening in the future.
You know, there has been some reports and some covering just in terms of some of the uncertainties surrounding when the money is going to be delivered specifically here to Intel. Intel facing this unclear path here to some of the biggest awards from the subsidiary program. I'm curious just to get your perspective on that and maybe what that would ultimately, or the challenge that then poses to Intel here, at least in the near term.
Yeah, the good thing from the CHIPS program perspective is it's a diversified bet. You have TSMC, Samsung, and Intel, all at the leading edge, all who've received PMTs, these preliminary memorandums of terms, to get the money. But the money hasn't come out yet, and that allows the government to use milestones and tranching to make sure that if you're not hitting those commercial or technical milestones, you don't get the money that you were supposed to get. And I think that's really going to be the key thing to watch going forward. You know, Intel has a big board meeting coming up in September. They've still publicly committed to hitting their technological and product milestones. That's going to be a big story to watch. And TSMC has reported they've reached some yields that are really close to what they get in Taiwan out of their Arizona fab. And many people weren't expecting that. So you're going to see positive news, you're going to see negative news. In this kind of industry, it's really important to have a lot of options. And you see that with the U.S. chip strategy. Watch those projects in Texas, in Arizona, in Ohio, in upstate New York. They're all going to have ups and downs over the next 10 years. But at the end of the day, we're going to be producing more chips in the United States than we were before, particularly on the most advanced nodes.
And then for the globalization and the partnership efforts on those chips, I mean, do you think, especially as we're looking forward to tonight's debate to see what business themes are discussed, chips could be one of those. To what extent do you think a deglobalization effort on one side of the aisle versus maybe kind of securitizing some globalization on the other side would impact chips specifically?
My view is that chips, given that it was passed with a bipartisan consensus, is going to be really durable. Why is that? Because when it comes to microelectronics, we're thinking about national security and economic security, and that's why so many folks rallied around it. So I think no matter what the administration looks like in the next 4 years or after that, there'll be a strong bipartisan consensus for chips because it is a matter of national security that we produce some of these most advanced chips and some of the more mature chips that go into our defense and weapons systems. And so I think chips is going to be just fine in terms of the political environment. I think the big question is execution risk, and that's something that we're going to need to watch going forward. I have confidence that they've done a good job up to this point, but we got to keep it up.
All right, Ronnie Chatterjee, who is the Duke University Professor of Business and Public Policy. Ronnie, thanks so much for taking the time here with us today.
Thank you for having me.
Certainly. Well, economic issues are expected to be much of the focus of tonight's presidential debate. Housing costs, taxes, and inflation at the front of minds of many voters, with this possibly being the only opportunity to see former President Trump and Vice President Harris debate each other this election season. What should both voters and investors be listening for when the two candidates hit the stage this evening? For more, we welcome in Tobin Marcus, Wolfe Research Head of U.S. Policy and Politics. So, for what we're expecting here, how much strength in agenda and actual tactical approaches do you think we'll hear from both candidates, Tobin?
So, look, I think in large part, this debate is going to end up being a contest of who can define the other candidate as the bigger risk. Harris certainly is the candidate that voters are heading into the debate with more questions about. So Trump is going to be trying to characterize her agenda and her record as radical and far left and out of the mainstream, out of step with voters' values. She is going to, try to explain this much more moderate agenda that she's running on now relative to where she's been in the past in terms that can connect with voters. So I think the room for kind of policy talk for incremental policy explanations primarily comes from Harris's side, because they're both going to be vying to define her and to talk about what it is that she stands for and will do. But I don't think that from an investor perspective, we're really going to learn a lot more about what it is that she's proposing beyond what she's already laid out. she's done this series of policy rollouts in recent weeks. Her campaign put up an issues page just this past weekend. So I think we've seen their considered judgment about what agenda they want to lay out to the American people. The question now is, can she explain that in terms that are believable to swing voters who haven't yet tuned in?
Tobin, when you take into account what's been priced into the market, we have certainly seen a shift, right? Ever since Kamala Harris joined the race here, and we've seen her poll numbers rise, obviously, versus Trump, versus what we saw when Biden was in the race. How much, I guess, in terms of what investors are rooting for or hoping for, what is the best outcome for the market? Is one clearly better than the other, or how should investors be evaluating that?
So I wouldn't say that one is clearly better than the other. I think that there's a mix of risks and opportunities in both scenarios. To me, from an investor perspective, thinking about the policy outlook in 2025, the most important thing to keep in mind in this very, very tight race, because I do think that it's going to continue to be not too far from a toss-up all the way through Election Day, is that Trump will probably have unified Republican control of Congress if he wins, whereas Harris will probably have a Republican Senate. So the policy outcomes in a Harris win scenario are divided government outcomes. She'll have control over personnel, but all the fiscal policy is going to have to be bipartisan deals. So there's no need to worry about things like taxes on unrealized capital gains, likely no need to worry about an increase in the corporate rate, which would be the big kind of market-wide headwind you'd worry about under her. I don't think any of that stuff is getting through a Republican Senate. Whereas in a Trump scenario, he might be able to get Republicans aligned behind a corporate rate cut, although I think that's probably challenging fiscally. But you do have to worry about his tariffs, which are both a direct headwind for a lot of industrial and consumer names, as well as a macro influence that could prevent the Fed from cutting as quickly as it wants to, as well as some of these more sector-specific both risks and opportunities, deregulatory benefits in sectors like financials, but also potential headwinds in sectors like clean energy, where he may try and cut or scale back some of the IRA benefits. So, a lot more room for change under Trump. Some sectors look a lot better than others as winners and losers from Trump, but I don't think it's a sort of uniform one's better than the other.
It's interesting, especially on the corporate side, the differing in backing and support that's adding up for Harris versus Trump here, and how that's kind of shifted versus what we've seen in past elections as well. So what are you anticipating to be the net weight that corporate America throws around in this election?
So, I think a lot of corporate leaders are trying not to get caught crosswise. If I were advising the C-suite of a company that had no need to get involved in the election, I would probably advise them to try to stay out of it, if for no other reason than because there's so much uncertainty about the outcome, and you don't really want to get caught on the wrong side, given, in particular, given the possibility of vindictiveness, I think more so from a Trump administration. But Trump certainly has lots of business support. I think much of that is coming from outside of the corporate sector. A lot of major leaders in the financial industry who have their own funds have been backing him. A lot of the Silicon Valley, kind of VC community is split between the two. Out and out, corporate leadership, CEOs, executives, folks that are responsible for big organizations, many of which are staffed by personnel that have their own loyalties. I think some of them have sided with Harris. She does have some business voices on her side, but a lot of folks have frankly been trying to stay out of it. The educational polarization in the country has definitely changed the lines around, where business leaders tend to go in terms of their support for the two parties. Increasingly, Democrats are the coalition of kind of highly educated America, which is where, of course, the workforce for most big corporations draws very heavily from. So that, I think, changes the considerations relative to how folks would have thought about it a generation ago.
Yeah, having to try and game out how vindictive a president might be if they win, not something I envy or anybody does from what corporate executives are having to go through right now as well. Tobin Marcus, Wolfe Research Head of U.S. Policy and Politics. Thanks so much for taking the time here.
Thanks for having me.
Certainly. All your markets action straight ahead. Stay tuned. You're watching Catalysts.
This is a stock market hanging on every single economic report as the economy slows down. Let's dive into all things economy with Goldman Sachs chief economist Jan Hatzius. Jan, always great to get some time with you, especially at your big conference here in September. Thanks for joining us. Maybe you can help us settle a debate we're hearing about in the markets. If the Fed will front-end load rate cuts, where do you stand on that?
Whether they will, we're still in the 25 camp. I think that's more consistent with the data that we've seen since the weaker than expected jobs report a month ago. I think Friday's numbers were, while a little softer than expected, nevertheless they did show a rebound. Q3 GDP is still tracking 2.5%. Jobless claims have come down. And then if you look at the Williams and Waller remarks on Friday, I think they were more consistent with 25 basis points on September 18th. I wouldn't rule out 50, but 25 does strike me as more likely. Now, in terms of what the rationale might be for doing more, I think there is a solid rationale for doing 50, and the rationale is that 5 3/8, 5.25% to 5.5%, is a really high funds rate. It's the highest policy rate in the G10. It is, despite the fact that the US has actually seen more progress on inflation than most G10 economies. So you could certainly make the case that they should be bringing down that rate quickly. Now, I think 25 is also defensible, though, because the way that monetary policy affects the economy is via financial conditions. It's not the level of the funds rate itself that matters mostly, but really financial conditions, and they depend on the path. If they do 25 basis points, I would expect them to signal clearly that there's going to be a series of cuts. I would also expect them to signal clearly, as Governor Waller did on Friday, that they'd be very willing to scale up the pace if the data disappoint. So it's, I think 25 is defensible. 50 you could certainly make a case for, but more likely 25.
What would a 50 basis point rate cut signal to investors? Would it signal that this is a Fed worried that the economy is slowing down more than expected?
Well, that's one of the challenges, and I think this is one of the reasons why the committee usually wants to go gradually, because that can be sold more as, look, we're just making some adjustments here. There's no reason to panic. And I think the people in the room that will be arguing against the 50 basis point cut probably will say, what does it say to the markets if we're doing 50 here? I think you can manage around that. You can say, for example, that this is really about just the level of the funds rate. Economy is doing fine, but the inflation emergency is behind us. And so therefore, we just think the current level of the funds rate is no longer appropriate. But it's always a risk, and you could get, at least in the near term, a more negative reaction because those kinds of concerns are prevalent in the market.
Why is the economy slowing down? Is the economy slowing down because of all the rate cuts that the Fed took, or there's something else at play here?
Well, I don't actually think that the economy is slowing down all that much. Yes, it is slowing relative to where it was maybe 6 months ago for sure, but that was very rapid growth, 3% or more. We're still tracking 2.5% growth in the third quarter. Our forecast for next year is only a few tenths below that, 2.25%. Those are very solid numbers. I think the main thing that's happened is that the unemployment rate has risen by 0.8 of a percentage point after the latest number on a spot basis. But a lot of that has been increases in labor supply. You've had this very large immigration wave, especially in 2023, a lot of that unauthorized immigration. And a lot of those people have entered the workforce and now are still entering the workforce, and it's taking some time to absorb them. And in the meantime, the unemployment rate rises. That's my hypothesis for what's going on. And so I think it's more the labor market rebalancing, labor market softening, rather than a big slowdown in growth.
It's not lost to me, a lot of the leaders that are in this room. NVIDIA CEO Jensen Huang will be here. We're talking to AMD CEO Lisa Su, a lot of AI-focused companies. When you're talking to these executives or you're in a conference like this, are you going to come away thinking that AI is really going to impact the economy, maybe more than a lot of folks think? And then what does AI mean to the U.S. labor market a couple of years from now?
So I'm definitely in the camp that AI will have a very meaningful impact on the economy. I do think that it's important to distinguish between particular sectors of the economy where that impact is very visible now. Certainly, data centers and energy, there are significant effects from AI at this point in time. And then the broad, $28 trillion of US nominal GDP, where it's still going to take, we think, several years before we see major effects. So that's sometimes the reason for the disconnect between maybe what the macro people say and what corporate leaders say in the space. I think in terms of the macro impact, say 5-10 years down the road, we lifted our long-term growth forecast for the US on the back of AI from 1.8% per year to 2.2% per year, sort of in the early 2030s. And that's a pretty sizable number. Obviously, it's not as dramatic sounding a number as some of the, more maybe micro or sectoral effects. But, for a $28 trillion economy, it's, or whatever that number is going to be 5 or 10 years down the road, it's a lot.
Our thanks to Brian Sozzi for bringing us that interview. Let's do a quick check of the markets. 90 minutes into the trading day. We're looking at a bit of a reversal. Right now, you do have the S&P back above the flat line. It's kind of been searching for direction for most of the trading day here this morning. You've got the Dow still in negative territory, although off the lows of the session, now off just about 200. The NASDAQ continuing to lead the way, up just about 0.2%.
All right, where Catalyst ends, wealth begins, dedicated to all your personal finance needs. I've got you for the next hour. Let's get this money. Stay tuned. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, we'll take the pulse of small businesses, their confidence halfway through the year, thoughts about the labor market, and even how they're planning to vote in the 2024 election. Plus, Apple introduced a new slew of products, including the iPhone 16, but is it worth the money to upgrade? We'll talk to an expert on that and get the answers you need. Plus, a new survey shows 25% of homeowners feel financially unprepared for costs of extreme weather events. We'll talk to an analyst who will make sure that you're prepared for that next event. All right, all these things and much more on today's show. First and foremost, let's start off, as we always do, taking a quick check of stocks. It's been volatile over the last month as uncertainty about the Fed, the health of the economy, and the upcoming election, they seep into investor sentiment. So, how can investors position their portfolios for any situation? Joining me now is Cindy Beaulieu, who is the Chief Investment Officer for North America at Conning. Great to have you here with us today, Cindy. So first and foremost, as people are thinking about positioning their portfolio, there's been a fair bit of uncertainty. Early August, we tried to rally back. Now early September, some of that uncertainty is re-entered into the equation. So how can people guard against what's known as the September effect in their portfolio?
Great to be with you, Brad. And yes, there is certainly a lot of questions out there, more questions than answers right now. We've got a presidential election ahead of us that is way too close to call for both the highest seat in the country as well as the congressional races that exist out there. So that is certainly weighing on people's minds. Fed uncertainty is a big question as well. And so what we have seen is a fair amount of volatility seeping back into markets again. We've had a pretty dramatic drop in interest rates that really got underway in that period you mentioned in August. And despite the fact that we've tried to move rates a little bit higher since then, we haven't really accomplished that. And that goes back to more of the Fed uncertainty than anything else. For the elections themselves, they are weighing on equity markets. There are a lot of questions about the policies and plans coming from either side of the aisle. And so as long as we continue to have that, we anticipate that there will be a decent amount of equity market volatility right up until the day of the election. So right now, it's best to stay pretty close to neutral in equity markets and fixed income, and be ready with dry powder for those opportunities as they present themselves. They will present themselves. We still believe that the U.S. economy is in pretty decent shape. Yes, decelerating, but decent shape. So sit tight and look for those opportunities to buy dips.
And so where are those strongest opportunities that people should be keeping the pen and pad ready for?
Sure. I think technology has certainly been a huge part of the equity markets for quite some time now, and we don't see that going away. So I think you have to be prepared to move on dips in technology. Healthcare is another area of the market that we expect to see a decent amount of activity in and some opportunities in going forward. And then financials. We're hearing right now about the Basel III expectations and what that might look like. And so financials do have some legs to them to possibly perform well going forward. For the fixed income markets, this is a time where you want to be as neutral as possible in duration. Spreads have moved fairly tight across a number of different sectors in the market. And so, we're looking again for opportunities there, especially if we see rates soften at all, as maybe there's some disappointment that comes from the Fed next week.
And so with that in mind, I mean, we've been looking across the 5, the 10, the 30, and we just tossed that up on screen here. For the Fed and all of the conversation that is certainly swirled around whether or not it should be 50 basis points or 25 basis points, should the depth of the first cut here to initiate the cycle be at top of minds of fixed income investors, or should it be the terminal rate that they should be paying close attention to?
Ultimately, it should be the terminal rate, but this Fed has gotten everyone laser focused on data, and data drives that decision for that September 18th vote. And then what happens from then going forward? And so being so data dependent, it's very difficult to look out further and have a projection. The Fed is still determined that they are going to get to their 2% target. That is not something we agree with. We actually think they're going to continue to struggle to get there. And at some point, they're going to have to realize and possibly move up the expectation for what is normal inflation in this country. Should that happen, then that obviously has implications for where the terminal rate will settle in. We're not a believer that 50 basis points is the right move next week. I mentioned the economy is in pretty decent shape. Yes, it is decelerating, but right now, third quarter expectations are for 2.5% GDP growth. That's pretty decent by any measure. So we do not have an economy that is falling out of bed. It is getting softer in spots and weakening a little bit, but that's manageable. And that's why 25 basis points we think is the right move at this next meeting, and possibly a pause at the November meeting. I think elections are weighing on the Fed's mind, and not that they are political, but this is about the uncertainty created in this particular election cycle, and especially around policy, what that could mean for monetary policy going forward.
Yeah, certainly. The Fed does like to make sure that they seem as apolitical as possible, and ultimately kind of leaning into that dual mandate. But since you mentioned the political spectrum that we are faced with every 4 years in the general election, should investors position their portfolios differently based on who's elected president in November?
You know, it's tempting to do that. But the reality for our country is that, yes, the seat of the presidency is the highest in the land, but they can only do so much on their own, and the makeup of Congress is what matters much, much more. And so we have an election right now for the presidency that is too close to call by statistical standards. It's a dead heat. And then you look at the makeup of Congress, and right now it does look like the Republicans are set to take the Senate and possibly even the House in the most recent survey I saw. So that's going to be a little bit interesting as we progress here through these next 2 months, because the idea of one party controlling Congress is something that we haven't seen in a little while. That does have some implications going forward. But those are the types of things that matter. Yes, obviously, whoever sits at the helm is very important, but the entire makeup of the presidency plus Congress is really how we'll shape policy. And so that's why it's so hard to position for anything right now, because Kamala Harris can talk about all the different things she would like to do, but if she doesn't have the support of Congress, she's not going to get very far. And I can say the exact same thing about Donald Trump.
Cindy Beaulieu, who is the Conning CIO of North America. Great to have you here with us today. Thanks so much for the time.
Great to be here. Thank you.
Certainly. Let's switch gears here. Let's talk a little retirement. There is a huge chasm between what Americans say they'll need in retirement and how much they actually have stocked away, regardless of age. According to a survey from investment manager Schroders, Americans with employer-provided retirement plans estimate they'll need $1.2 million to retire comfortably. Nearly half expect to have less than $500,000. The pre-retirement panic is real, so why the disconnect? Here with the details for us, we've got Yahoo Finance senior columnist Carrie Hannon. Hey, Carrie, what do we know? And take us into some of these stats.
Exactly, Brad. Great to be here. Yeah, I mean, we hear this over and over again, this sort of pre-retirement panic, right? They're miles apart, people who aren't retired yet and those who are retired. And there's this duality. And what we found is the most recent survey that came out from Gallup found that 8 in 10 people who were retired between the ages of 65 and 80 said, hey, things are fine, things are good. So what's this all about? And other surveys have found the same thing. The Employee Benefit Research Institute repeatedly finds that people are panicked. Once they retired, they kind of take that chill pill, as I like to talk about. So what happens here is it's this sort of matter of the unknown. I think people, don't know what to expect. They are just terrified that if they don't have a paycheck, their world is going to fall apart. And the ones that tend to really get there and say, hey, everything's cool, is the people who have taken the time to do a little advanced planning. You know, what am I thinking about Social Security? When do I want to take it? Running some numbers, working with a financial advisor, all of these things help calm you down and give you sort of an idea. We never know what it's going to be like when we get there, but this disconnect is really quite real. And we spend a lot of time talking about the nervousness and the people not saving enough and woefully unprepared. But I think when they actually get there, many people simply adjust. They figure out that, hey, the cost of living maybe isn't quite as high as they expected, or they've made the moves to make that happen. And the one last point I'll make is the most important thing is pre-retirees often say that they're going to start taking their Social Security benefit as soon as they can before their full retirement age. That's a huge mistake. If you have the ability to delay till age 70, you'll get the bigger check for the rest of your life. And so that's throwing in my 2 cents on that one.
Carrie, excellent breakdown as always, and read through the statistics there. Appreciate it as always.
Thanks, Brad.
Thanks. Coming up, everyone, we're checking in on Main Street with the chief economist from the National Federation of Independent Businesses. Stay tuned. You're watching Wealth. The mood on Main Street worsened in August. This is according to a survey from the National Federation of Independent Business. Small business owners' feelings of uncertainty ticked up as well. Folks reporting that they're wary of future business conditions. Joining us now to discuss this, we've got Bill Dunkelberg, who is the NFIB chief economist here. Bill, always a pleasure to get some of your insights here. I check out you guys' survey on every publish here for the Small Business Optimism Index. What is the leading cause that you're seeing right now for some of the shifts that we're seeing in optimism among small business owners and operators?
Yeah, well, we, of course, have been looking at optimism for 50 years. We take a random sample of NFIB's 300,000 plus member firms and ask them the same questions over and over and over. It gives us a good time series on things. The index is now around 91, fell a couple of points from like 93. But 91 is kind of where it's been for all year. And the 50-year average is 98, so you can see that we've been below average for a long time. So the level of the index is clearly indicating that we're in a recession or a recession period. You can tell by looking back at past recessions and seeing where the index is. The biggest thing driving the index down, of course, is really poor expectations about business conditions 6 months from now and expected sales over the next 6 months. That's not looking good either. So they don't see any good things happening. Virtually none of them, 4%, I call that none, but 4% say now is a good time to expand their business, meaning nobody thinks it's a good time to expand the business. And capital spending is still historically very low. So that all adds up to kind of a dim outlook for the small business sector.
Small businesses play a huge role when it comes to the employment situation as well, Bill. I wonder if there's been any moderation from what you're tracking in how small businesses plan to hire or even make sure that they're securing their workforce.
Well, about 13% said they plan to increase their workforce. That's down a little bit all year. We've been trying to hire for a long time. Our job openings, 40% have job openings that they say they have trouble filling, and it's been historically high all year. We're trying to hire, we just can't do it. So we find that 90% or so of those who try to hire or succeed in hiring say that there are few or no qualified applicants for the positions that they have available. Now, we do have a few high-tech member firms, of course, in the small business sector, but most of these are not jobs that require a lot of training or skill sets.
And so with that in mind here, we're also thinking about what is set to come. And we were just talking about the general election. We know that there's going to be a lot of focus on small businesses, and particularly one survey that we've also been tracking here as well, a mid-year pulse on small business decisions from Bluevine as well. Talk about the election coming up and the outcome of the election remaining uncertainty. Majority of small business owners planning to vote for a candidate who aligns with their personal ideals over business-friendly policies. I wonder what you're hearing as well in terms of how this election plays into business strategy for small business owners and their optimism.
Yes. Well, we don't ask our members what their political affiliation is or how they plan to vote. It is true that the uncertainty amongst business owners now is back at record high levels. Looking back at where we were in 2016, so the uncertainty is really rising, and that's not a good sign. Of course, uncertainty is the enemy of economic progress. People who are uncertain about the future don't spend money and don't hire. So that's the issue that we have here. So I don't know how these people are going to vote, but obviously it'll be important because there are 14 plus million small businesses on Main Street, and I'm sure that lots of them vote.
Bill, appreciate the time as always. Bill Dunkelberg, who is the NFIB chief economist, taking some time here with us on Yahoo Finance. Appreciate the insights.
Thanks, Brandon.
Certainly. Turning now to a slightly different take on the state of small businesses, fintech company Bluevine, which offers banking services for small businesses, out with a mid-year business owner success survey. And the results reveal small business owners are largely shaking off the high costs of inflation, interest rates, and political uncertainty. In fact, 88% felt that they met or exceeded business expectations in the first half of the year, and that confidence is spilling over into the second half of the year. Here with more on the takeaways, we've got Eyal Lifshitz, who is the CEO of fintech company Bluevine. Eyal, great to have you here on the program. So, I mean, how are you seeing small business owners feeling and projecting for the second half of the year?
Well, certainly the sentiment is positive. As you noted, strong first half of the year, almost 90% met or exceeded their expectations. So coming off a first strong half, the sentiment continues to be positive in the second half. Almost 3 quarters, as you're showing right now, feel good about the second half, even though uncertainty is increasing with the elections, with inflation, with taxes. But overall, what we're seeing is that generally they are positive.
And so with that in mind, what levers do you see small business owners pulling right now to make sure that they can essentially safeguard their business from any type of broader macroeconomic trends that otherwise could put a dent in those business prospects?
You know, it's an interesting question because on one hand, you see small businesses that are quite positive, but in our opinion, they're not doing enough. We are seeing that they're still making, in our opinion, avoidable mistakes in running their finances and their planning. For example, we're seeing that still over half are using credit cards as personal credit cards as their main source of financing. Only about a third have a line of credit in place that they can utilize for smoothing out cash flow or for even growth as they need it. And then only about a half of them are in a position to weather a cash flow crunch. And so we think they could be doing better in terms of utilizing the right sources of financing and also planning better for uncertain times.
So what are some tips for small business owners to avoid those financial pitfalls that you were just mentioning?
I'd say 2 things. The first one, plan ahead. Plan for different scenarios. Right now, we have certainly uncertain times in terms of interest rates and inflation. So plan for good and plan for bad. And when it's good, be able to be in a position to take advantage of the situation, but also in cases where things become tougher, be in a position where you're able to weather the storm. And for that purpose, as an example, having the right financing in place and getting that financing while things are still good. And the right financing is not a personal credit card. For small businesses, we would recommend having a line of credit in place. You don't need to draw on that line of credit, but having that as a cushion for when it's needed. Again, not just for bad times, when you need it to smooth out cash flow, but also to take advantage of opportunities as they come.
All right, at the September FOMC meeting, we're all anticipating a rate cut of some sort. How should small business owners think about rate cuts, though?
It's pretty inevitable that we're going to see a rate cut at this point. What is uncertain is the pace of rate cuts that are expected afterwards. What I would say right now is, as small businesses are thinking about financing, is not to get locked in to long-term financing with fixed rates, so they're able to essentially, if rates go down, they're able to enjoy lower rates. But at the same time, making sure that, right now, if they're in a position to lock in that capital, even if it's floating rate or if it's financing that they're able to utilize only when they need it, I think it's a good time.
Eyal Lifshitz of Bluevine, the CEO of Bluevine. Eyal, great to have you here on the program, and thanks so much for taking some time with us.
Thank you so much.
Certainly. Coming up, everyone, Apple unveiled the new iPhone 16 yesterday. So is it worth paying for the upgrade? Let's talk about that next. Apple held their latest event yesterday in Cupertino, where they unveiled a host of new products and features, including the iPhone 16, the 16 Pro, the Apple Watch Series 10, the launch of Apple's new intelligence features as well. But yeah, here's the cold water. These new products and features, are they worth paying for an immediate upgrade? That's the big question, and here to help us is Bridget Carey, CNET's editor at large. Bridget, I mean, you're making the face that says no right now. I don't even have to ask the question.
I think it's the question we always ask because our phones are lasting longer, we're holding on to them longer, and you kind of go, all right, do I really need it? So I look at Apple's presentation from the angle of, okay, what's Apple going to focus on when it talks? And so yesterday, you heard a lot about some magic words. Battery life is better.
Yeah.
The camera, and this is the reason that people upgrade. And then yes, there was a lot of talk about AI because that's right now in the tech space, but that's not coming out when the phone lands on September 20th.
Right. Some of the analyst reviews that we had seen come out, and I'm not going to get too close to the, just how Wall Street is looking at this, but I mean, the mode of this was largely no surprises, and ultimately, this looks like a software type of year. That doesn't sound sexy for people who were looking to try and figure out if they should spend hundreds of dollars on a new phone.
You look at what Google and Samsung even present, it's always like very AI heavy. This one actually was a little bit hardware heavy up front. And I think the star of this iPhone event wasn't the iPhone. It was the updates to the watch, the AirPods. This is the kind of thing where maybe people go, oh, I don't mind spending that to get an upgraded, experience in health tracking with sleep apnea or having some sort of new, audio experience rather than drop down, a lot for a new phone if their phone is still good. So right now, people might be waiting to see what the reviews are on the phone before just immediately hitting buy on the pre-orders.
Yeah, I mean, look, I'm inevitably going to be able to, or will have to upgrade to the new AirPods anyway when I lose the current pair that I had to buy because I just found one of the AirPods behind software or a console in the apartment. All that considered, so I'm going to get the new AirPods at some point. But the Apple Watch, I think, so some of these other devices, the wearables, how much do you think that the features are actually enough to tell consumers mentally, like, all right, I'm going to get more healthcare features in this, and is that enough to make people try to initiate that new purchasing cycle for an Apple Watch or other wearables?
It's been 10 years since Apple came out, introduced the Apple Watch. This one's larger screen. I think it's going to be, kind of making people's heads, turn a little bit like, oh, a larger screen now. Oh, I can be able to monitor all these different health issues because it just keeps adding up every year with the sleep apnea. It's kind of giving you a heads up if you might have a problem with your breathing during your sleep. But when the price point is lower than the phone, yeah, people go, okay, maybe I'll upgrade into that. And what's interesting is that the $400 new Series 10 watch is larger of a screen than that high-end $800 Ultra watch. So people who might have been holding on might, kind of go in a different direction when they want the 10 instead of the Ultra, maybe.
I mean, the pricing power that Apple has been something that's talked about by analysts a lot, but from the consumer side, is there enough of the wow factor to support the pricing that Apple puts into the market at this juncture right now?
The phone prices haven't changed, right? So people are kind of getting used to it. I thought it was interesting in the messaging that you start to see in these presentations from Apple that they kind of lean more into the whole, hey, with a trade-in, with a trade-in, you can get a little discount.
Right.
So they're kind of like letting consumers know, hey, if you have your old devices, why don't you go ahead and upgrade? It's just a different way of kind of pitching the same thing. But I think people still like those AirPods, and they might actually, if they haven't upgraded in a while, look at those.
Yeah, all right, well, a lot of it felt like a personal attack when they were saying you need to upgrade and just trade in that old phone, because I am one of those people.
Because people don't really care that much about AI right now.
Yeah, no, and my phone works, so that works too. Bridget Carey, CNET's editor at large, joining us here in studio. Thanks so much for the time.
Thanks, Fred.
Absolutely. Much more on wealth after the break. Stay tuned. You're watching Yahoo Finance.
jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
We're in the midst of hurricane season. Tropical storm Francine barreling towards Texas and expected to make landfall on Wednesday in Louisiana. Forecasters are ready to declare this storm a hurricane later this afternoon. With extreme weather events becoming more frequent, both homeowners and renters are left feeling financially vulnerable for the costs associated with these severe patterns. More than 1 in 10 U.S. homeowners say that they are unprepared to meet these costs. This is according to Bankrate's 2024 Extreme Weather Survey. For more on weathering the costs of extreme weather disasters and systems, Shannon Martin, insurance analyst at Bankrate, joins us now. Shannon, thanks so much for taking the time here with us on this very important topic, especially as we're tracking Francine and the number of billion-dollar disasters that have certainly become even more in focus by NOAA over the past 5 years. All of this considered, how does this change where people need to financially prepare for some of these extreme weather events?
Well, Bankrate's Extreme Weather Survey was a type of pulse check for American homeowners to see how they felt starting into this hurricane season. And we found that 26% of American homeowners say they feel financially unprepared for the impact that extreme weather can cause. Now, this number, of course, changes depending on the demographic you're looking at, based on income or location. But many American homeowners are starting to be more and more concerned about the impact of extreme weather on their finances.
I mentioned the National Oceanic and Atmospheric Administration and what they're tracking and the number of 2024 billion-dollar events that have taken place. We've already seen in 2024, and this was as of August 8th, 19 confirmed weather or climate disaster events with losses exceeding $1 billion. And the national average over the most recent 5 years is 20.4 events. So we're already on the cusp of that, even as hurricane season is kicking off here. So what are the core changes, the differences that homeowners need to take into account as they're trying to figure out exactly how many of these events could hit their area?
What our survey found out is about 39% of homeowners review their home insurance or auto insurance policy within the past 5 years to make sure they had the right amount of coverage. And that might seem like a very small step, but it's one of the most important ones. Places like California, Louisiana, Texas that are getting hit heavy with wildfires and hurricanes, some insurance carriers are changing how insurance is covering those types of losses. We already know in California, wildfire is starting to be an excluded coverage. And most of us know that fire is generally always included in your home insurance policy. So by understanding what you're covered for can really be the first step in financial preparedness.
We're showing here on the screen right now how renters can prepare for extreme weather. Can you run through some of those tips and how people who may not be owners, but certainly do own property within the property that they are renting, how they can protect themselves?
Absolutely. If you're a renter, you still take pride in where you live and the objects and personal property that you've accumulated. And a lot of the advice will work for homeowners and renters. So first, you want to build up an emergency savings account, not just to be able to afford your deductible, but in case you need to evacuate or purchase mitigation supplies, you need to be able to have the money to do that. And then review your insurance policy. Work with your agent to see if there's any coverage gaps that you can find coverage for. And then shop for disaster preparation off season. I'm from the South, so if I wanted to get a portable air conditioner, I might look for it in winter when the price is at its cheapest.
And then just lastly, while we have you here, Shannon, in terms of the number of different areas that are continuing to be impacted, how much do you think this will change the type of home, the geographical locations of homes that people are willing to buy as we're kind of looking at interest rates and where those could potentially come down and have a flock of people who are looking to get into the home ownership landscape or the home ownership realm, and where that is going to move forward and where they're buying as well, and that consideration?
I think the number one takeaway is to make home insurance part of your home buying plan. You need to understand not only the area that you're looking for when you're looking at safe school districts, and if it's close to family, what financial commitment are you making to the extreme weather now and the weather that'll develop in the next 10, 20, 30 years while you live in that home? And that will definitely change just everyone's mindset and where they're choosing to live.
Shannon Martin, who's the insurance analyst over at Bankrate. Shannon, thanks so much for taking the time and for some of these valuable tips as well for homeowners and renters. Appreciate it.
Thank you for having me back.
Certainly. Coming up, everyone, getting retirement ready. We're bringing you part of Yahoo Finance's new podcast, Decoding Retirement, when we return.
I want to talk more about the book, and in the book you have some actionable advice I want to get to. One is this notion of STASH, the acronym, and how young adults can hack their brains to stash more money.
That's it. And we have actually been talking about it a little bit, right? STASH stands for sort of the 5 things you should be thinking about. Number 1 is save for a rainy day, right? That emergency savings fund. Number 2, tax advantage savings. So using the power of compound returns and the growth of that money to really grow your money. So T, tax-aware savings. The A is assess your budget and pay off debt. So once you start your emergency savings fund, once you're getting at a minimum the match, which is your first target, right, to get that match and get the free money free money. Then you start paying down debt. Now that is there's some disagreement in the people sort of talk about this stuff, about whether you should be tackling debt first or long-term savings first. For me, the power of compound return over time plus the 401k match, if you get it, is more important than aggressively paying down debt. Once you get that match, you get the free money, which is doubling your return because they're doubling what you put in right out of the gate. Then you aggressively pay off debt. After you are debt-free for everything but low interest rate debt, and again, people can argue about what that means. In my book, I refer to anything under 7% as being low interest rate, which is less than what you might earn in the stock market or in a balanced portfolio. So typically a mortgage, some federally guaranteed student loan, right, is below that 7% rate. Everything else you should be paying off as fast as you can. Then you go to the fourth step of stash, which is the S, which is max out stay the course and max out on your retirement savings and get up to that 10 to 15%. And then the H stands for have fun. Right? Once you get to that, let's call it 15% savings rate, you really should then be allowing yourself to enjoy more. Maybe you're going to save more money and save it up for a bigger down payment or for a fancy vacation. Or maybe then you want to think about not retiring at 67, but at 60. Or, that's when you have a little more room to think about different kinds of goals. But, I think executing that stash is really about making sure you've got the emergency savings fund, you have eliminated all of your high interest rate debt, and you are putting, again, 10 to 15% into that long-term savings.
Right. So as you're talking, and you mentioned the ant and the grasshopper story a little bit ago, I think about how many young people have two things going on: present bias, the possibility that they value today's dollar more than tomorrow's dollar, and this notion of fear of missing out and having fun. So I'd rather go out to this and do that, or this concert, or go to London and see Taylor Swift, or whatever the case may be, because tomorrow I'll have another dollar and I can worry about that then.
So true. So true. I mean, I'm out there giving speeches and stuff, and in one of my speeches, I won't do the whole thing now, but I'm like, so I'm watching Netflix, and it's 10 o'clock, and the next episode starts, and I hit skip intro and think, wait a minute, what time do I have to wake up? And then it's 10:30, and then I hit skip intro again, and then the next thing you know, it's 1 o'clock in the morning, and you think, I've only got one episode left. I'm going to keep watching, right? We've all done that. That is present bias in action right there, right? What is happening right now is far more important than the future, which is tomorrow morning, right? So it's a thing. I think the most important thing we can do is get curious about how we are wired. Like, it took me a really long time to accept that I am a grasshopper. I routinely start reading a book at 9:30, and at 2 o'clock, I'm like, oh boy, am I going to be sorry tomorrow. I still do it, right? And I have learned not to let myself start reading without either setting my phone alarm on and putting it across the room so I have to stand up to turn it off. Okay, that's my signal. Stop reading and go to bed. Like, I'm bad at that. I'm bad at that kind of impulse control, right? I just am. So I know that about myself with something as silly as staying up late reading a book, and I can then create hacks, turn on my phone alarm, set it out of reach so that I have to stand up, which disrupts me enough to go, wait, whoa, what time is it? I better put my phone, I got to go to bed. You can do that with food. You can do that with money, right? How do I understand what my own biases are, my own impulses, enough to figure out how to interrupt them, right? So one of the most powerful things that is now helping Gen Zers and anybody who changes jobs is getting automatically enrolled, right? When you and I started working, we got these, 150 or 200 page enrollment kits that we had to fill out and mail in with hundreds of pages of information to look at. Like, that was horrible. What the stats were, 50 to 60% of people signed up. If your employer signs you up, only 3 to 7% of the people drop out, right? It's magic. That's a huge hack. So is your employer automatically increasing your savings rates. That's another hack. Most people stay with the plan. They don't drop out because they know they should. if your employer doesn't do that for you automatically, you can do it to yourself by, again, either asking them to increase your contribution rate or just saying, hey, Jan 1, got a raise. I'm gonna bump up my rate, right? Those are hacks that will help you stay on track.
So as I look at your book and the topics in there, and I think about your children, which you, I believe, dedicate the book to.
Yes.
So have they incorporated your advice?
It's funny, my older son, like me, has an eye for, like, you could put me in a store with no price tags and I would unerringly find the most expensive thing. It's a gift. Not a good one, but it's a gift. And my older son is like that, but he is being really ruthless about creating guardrails for himself. And he is 100%, my children were also fortunate enough to graduate from college debt-free. That was something my husband and I felt very strongly about. They're on their own for grad school, but they have managed to, get out of college debt-free. And so that is a huge boost that they, and I said that to my son when he started. I'm like, well, look, you're not paying off student loans. You should be throwing money in your savings plan. So they're following that. My younger son is much less like me and much more like my husband. He's like, I don't have the money. I don't care. But he's also a musician and is going to be leading a really different life, right? It's all on him to be saving and investing. And, we've had a lot of talks about how do you think about managing a gig world when you don't have a 401k, you don't have somebody automatically enrolling you. How do you think about structuring your spending if you have great uncertainty about what your income's going to be like?
Yeah. So, quick question. Given the amount of jargon and how obscure this can be to some people whose day job is this, and this requires a whole nother day job, should young workers go to a financial advisor for help?
I think financial advisors can be incredibly helpful. I think most people starting out have pretty straightforward financial lives. And not to talk what I used to do for a living, I used to manage target date funds for a living, right? So I think a target date fund is a great answer for someone just starting out, or a balanced account, or a robo platform. I don't know that you need a financial advisor unless you are struggling with how to budget and save. And then I think having someone who can help you understand your own finances, understand where your money is going, someone who takes a percentage of your assets when you're just starting out, I think those fees are probably going to be very high, and there might be other places to find that kind of help.
So, Ann, it's now time that we turn our attention to questions that we get from our readers and listeners about money and retirement in the segment that we call Ask Bob. The first question that came in essence, goes like this. Is there an upfront charge when I convert my traditional IRA to a Roth IRA? And in essence, the answer is no, there's no one charging you a fee to do that. But, however, you will be paying ordinary income tax on the distribution from your traditional IRA, and you need to be aware of what that tax will be and how it might affect other things. If you're a Medicare beneficiary, you might be subject to IRMA if that puts you into a higher income bracket. Modified adjusted gross income is the jargony term. And if you're pre-Medicare and on the ACA plan, it could affect the advanced premium tax credit that you get.
And it can also bump you up into a higher tax bracket. So it's interesting. I was just talking to my parents' financial advisor about that. My parents are both in their 90s and doing some chatting about just this subject. And it was going to bump them up like 4 tax brackets if they did a conversion. It's like, well, never mind. We're just going to leave that money right where it is. Thank you very much. Because it would radically alter all kinds of things. Now, most people, again, if you're younger, may not matter that much. We can chat a little bit about, if you're just starting out and have the choice about contributing to a Roth or a regular, like we can talk about how you might think about that decision. But that conversion, right, the government's going to make you pay, not necessarily your service provider. That should be free.
Yeah. So one last final word is you don't have to do a full conversion. You can do a partial conversion.
Right.
So another question that came in is, can I withdraw money from my Roth IRA after I've contributed? And the answer is yes, if you've held that for 5 years. Otherwise, you'll pay a penalty on that distribution. And there are a couple other nuances to that. But in essence, if you've had the Roth IRA open for 5 years, you can withdraw money from it. Any thoughts?
Well, 59 and a half is one of those ages that you need to pay attention to. Where the half comes from, I do not know. But that is the age from which you are sort of normally allowed to start withdrawing. Before that, you'd pay a early withdrawal penalty. Roth IRAs have other things you're allowed to pull money out for, down payment on house, education expenses and stuff. So, a Roth gives you a little more flexibility, but you still have to keep an eye on the fine print.
So thank you, Ann, for sharing your thoughts on these questions from our readers and listeners. If you've got questions about money or retirement, email us at askbob@yahoofinance.com. That's all the time we have today on this episode of Decoding Retirement. Stay tuned for future episodes where we'll be talking to other experts who can help you plan for and live in retirement.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
That was Robert Powell and Ann Lester on Yahoo Finance's debut episode of Decoding Retirement. Let's do a final check of the markets as we're taking a look at the major averages right now. The Dow, the S&P 500, and the NASDAQ have all slipped into negative territory. Right now, the Dow leading the laggards, or leading the declines, I should say, on both a percentage and point basis, down by about 0.7%. The S&P 500 down 0.25%, and the NASDAQ down 1%, or 0.1%, excuse me. All right, that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. Stay tuned. You can catch Market Domination. That begins at 3 p.m. Eastern Time with Julie Hyman and Josh Lipton.